Hey, welcome to another edition of the Small Money, Big Dreams vlog. I'm your host, Morgan Spanam, and today's topic will be growth stocks. Now, a lot of times, you guys probably heard me discuss growth stocks in previous vlogs, and want to know in particular what's considered a growth stock. A growth stock is a stock that has a high price-earnings ratio, high price-to-book ratio, have high earnings growth, high sales growth, and low to no dividend yield. So what does that growth stock mean to you? And still, you heard what I said about the ratios, but what does a growth stock mean? A growth stock is a stock that has shown popularity because of its future earning potential. So even though the company or stock hasn't, shown great sales or earning potential, they've shown an increase in these things, and people feel that these stocks can only go up. So people will pay higher prices for these stocks, even though the financials may not result in these stocks. And growth stocks, are, for lack of better words, are the fancy, attractive, sexy stocks that people feel like they're hot, they're going to continue to reach to the top. Examples are the Amazons and the eBays and the Apples and the Googles. And even though these stocks or companies haven't shown huge sales and earning potential, just the buzz around these stocks continue to grow, so people are paying higher prices for these stocks than maybe their financials prove. Apple, amongst these stocks, has shown great revenue with its popularity in the iPod and its operating systems, as well as its computers. But other stocks that I've named, Google, eBay, as well as Amazon, have shown great popularity, have shown earning potential and increase in sales over the last couple of years, but the price of their stocks and their market capitalization usually represents ratios of up to 20 times, 30 times in earnings, and even in price to book, upward of 10 times price to book. So growth stocks basically represent stocks that are very attractive, very popular, and for the long run, people believe only going up. Now, my warning with growth stocks is sometimes growth stocks have reached their peak, their maturation, their point of most interest, and you have to be aware of not buying into a growth stock that's reached its peak, because it can only go down from its peak. So I say, when approaching a growth stock that has a high price earning ratio, high price to book, price to sell, and low to no dividend yield, which means they don't pay any dividends, or if they do pay dividends a month for their common share stock, it's very little. I say that understand that these stocks are nice to have in your portfolio, but realize that they have potential in the future to either go up or go down. So I would say, if you do like the growth stocks and you just want to have that exposure, make sure you monitor these growth stocks and not hold on to them longer than you should. Ask yourself, what are the companies working on? What is the buzz around the companies? Do they continue to have the buzz they had yesterday? And with growth stocks, you got to monitor more and read up on the companies to make sure that they're continuing to keep the excitement and the momentum growing and not let that fall off. So, in a nutshell, growth stocks represent stocks that are highly hyped and have high earning potentials, high sales potential, and although the value of the stock and price is very high, the return from the financials don't actually meet those expectations. So I say growth stocks aren't a bad thing, but proceed with caution. I hope this helped explain to you what growth stocks are and how they should be invested in. This is your host, Marvin Spanam, and I hope you guys come back to learn more. See you guys on the top.